my paper is on accounting fraud and whether or not Sarbanes-Oxley was the answer to a major problem that was making headlines all over the place in the late 1990s and early 2000s. Accounting fraud is a term used to describe theft perpetrated against a company, normally by people within that company. It can involve stealing of inventory, manipulation of financial statements, any number of other things that basically result in the loss of money to a company. There are several different types of accounting fraud. The asset misappropriation, which is just theft, like I had mentioned earlier, selling of trade secrets, recipes, customer lists, things like that, depending on what type of business it is. Financial statement fraud, which is the most rare of all types of accounting fraud, but the most damaging. There's also bribery and corruption that can happen in an accounting world. That could defraud shareholders and other investors. Financial statement fraud is extremely complex. Can be anything from overstating revenue and understating expenses to overstating assets. Any manipulation of the financial statements, so improper use of reserves, mischaracterizations of one-time expenses, omitting information, leaving things off, things that should be whether in the line items of a balance sheet or income statement, or just notes that should be added on, anything that's going to persuade or dissuade somebody from investing or using that business for something. Fraud is extremely complex and is discovered in multiple different ways, but normally by somebody within the accounting department, whether that be somebody in purchasing or a buyer or somebody in inventory control, a receiver in the warehouse, depending on what type of business you have. Internal accounting personnel most often is who discovers a discrepancy that then is investigated. External auditors will discover fraud. Shareholders, if they're starting to ask questions or if they want to look at balance sheets and financial statements. Governing boards. There are many common indicators of fraud, especially low-tech indicators, such as dates with a pattern that show up in the accounting software, in your accounting books on the general ledger, oddly behaving staff living beyond their means, getting money that wasn't paid out in payroll, unexpected romantic relationships. There's also the high-tech indicators, which are primarily governed by new software that's been created for this purpose to help detect fraud. It has many far-reaching effects, and as I mentioned at the beginning, those large cases in the 90s, early 2000s really shook financiers, people who were investing in public-owned corporations that were having huge problems and a huge multi-layered fraud throughout their companies. This led to government intervention in an attempt to deter criminals, minimize fraud, increase public confidence, which had been extremely shaken. Two of those cases I'm going to talk about in just a minute, Enron and WorldCom. Enron was a long time ago, and I was a lot younger then and paid a lot less attention to things in finance, but I will say that I remember it all over the news. They were an energy company, and reading about it just recently here, I guess I didn't realize the depth or the scope of what they were really doing. Citibank, JP Morgan Chase, their external auditors were all either involved or choosing to look the other way, and they sunk that company. It was greed motivated. A lot of people lining their pockets. A lot of dummy corporations were created. It cost the investors a great deal of money, and it put that company out of business, and people went to jail. WorldCom is a little bit smaller in scope. The accounting professionals were recording routine expenses as capital purchases to hide the financial problems that the company were having. The idea, or basically the thought behind it, was that they were hoping to buy more time so the market could bounce back and they could repair what damage had been done and the funds that had been lost. Right after that, in early 2002, is when Sarbanes-Oxley was passed. It had three major goals. One was to change the landscape of external auditing and financial consulting. They also wanted to create a governing board that would oversee the regulations and practices, and to improve corporate governance by reducing fraudulent financial reporting. Auditors at the time could not only serve as external audit, but were also serving as consultants for these companies. So there was almost a conflict of interest for them to be auditing something that they were also consulting on. There was a lot of questions about the practices of audit and how it was being carried out and what the end results were. So they created the PCAOB, the Public Company Accounting Oversight Board, which would help to create the standards, provide oversight for all publicly traded companies. They also made more stringent punishments for those who failed to report problems or certified these accounting financial statements as GAAP compliant when maybe they weren't so much. People who perpetrated fraud, there was more jail time, more stringent punishment, and kind of just letting the accounting professionals know in the finance world know that, hey, we're watching and we're not okay with what happened with these other companies, Enron and WorldCom, and several other ones that were experiencing some serious fraud at the time. Despite SOX and despite what SOX was trying to do, there have still been major instances of fraud. Bernie Madoff was one of them. Part of what helped him was that he was a 70-year veteran in the industry, and so he had the confidence of a lot of investors. But he was still able to create a relatively complex Ponzi scheme, luring investors by promising high returns and then paying those new investors with money from the previous investors. And that can only go so long before people stop investing. He ran out of money. SOX definitely made a point. He was sentenced to 150 years in prison, which we all know at the age of whatever he was, 70, he's not going to spend that long in prison, but nobody can. But they made it known that they weren't joking, that this is not okay. He's committed one of the largest cases of finance fraud in the United States. Another one that happened after Sarbanes-Oxley was the IT Computer Leasing Group. Well, this was actually discovered internally by a vendor account specialist. So somebody who's just setting up vendor accounts noticed that hundreds of computers had been intentionally diverted to someplace else, and the director of that company pled guilty and was sentenced to 3 years in prison. So even though SOX maybe didn't solve the problem, I think that Sarbanes-Oxley definitely made it clear that the financial community is not just going to sit by and let people commit fraud, but it's not a problem that can be solved. It's like any other crime, I guess. You can't stop it. And partly because of the system. The financial system's open to everybody. We don't close it off to people. Anybody is allowed to be an investor. Anybody's allowed to come in and say, hey, I want to be, part of this company. I want to buy stock. I want to be a shareholder. It makes it really easy for people with financial savvy or financial education to take advantage of those people. And the legislation is complex, just as the accounting world is, and ambiguous, sometimes making it difficult to enforce and difficult for people who may not have that extensive of a business background to interpret. It's not an easy, even I, who have some financial background, read that Enron case multiple times before this is what they were doing. I have a very clear understanding now on what they were doing, but anybody walking in who wants to invest in a company or be a shareholder may not have that background, and it's easy to take advantage of those people. And that brings me to the other reason that we cannot stop or eliminate accounting fraud. The people who commit accounting fraud are driven by greed. They tend to be arrogant, and they aren't intimidated by the stricter penalties. Just like anybody who commits a crime, they don't think they're going to be the ones on death row. So they don't think they're going to get caught. And in a lot of cases, I'm sure people aren't getting caught. I do think that Sarbanes-Oxley is a good piece of legislation. I think it's great that there's been some separation between the auditors and the consulting and those practices, and I think that probably needs to continue and maybe should even be looked at further. Maybe there's more that we can do to really make clear what the checks and balances should be in an accounting office and in a financial environment. But I don't know that it's really done anything to eliminate or help contain accounting fraud. I think that accounting fraud is going to be something that we're always going to have to be looking for. And the more stringent we are with the punishment and the more clear we are with the guidelines, I think the better off everyone will be. But I'm still working on the paper and still reading. So we'll see in the next couple weeks if I discover something else or if I change my mind about something. Thank you so much.